Well, when one looks at asset management, is it as simplistic as finding a firm to look after your money? Is there maybe more to that than that needs to be considered? Well, for one, the industry has fundamentally changed and the drivers of it have changed as well. So what can we learn from the long-term executives of the asset management world? And as we said earlier, a collective insight is the article that we're going to be taking a look at today, and the title there, Anne, is How the Asset Management Industry in South Africa Has Evolved. I mean, you started off by talking about how the industry has had to grow up very fast. So what is your assessment of where it is right now on the maturity scale?
Look, I think I'd take our asset management industry and put it on a par with any developed capital markets. Wouldn't you guys? I mean, I think we have a superb asset management industry, very professional, very sophisticated. Mm-hmm. So it's right up there with the good guys.
So what would you say, because I mean there are of course a lot of issues still in the industry that need to be ironed out, a lot of challenges, and I suppose not specific to South Africa. What would you say are some of the positive developments that we have seen in the asset management world?
Whoa, you mean after the global financial meltdown, what are the positive developments?
Well, I suppose there have been a number going back to, you know, the 90s and even before that. If you could just kind of pull out some of them that really stand out for you.
Look, I think, and I'll put this specifically within the context of South Africa, I think the biggest leap forward that you saw here in South Africa was the recognition that this was a profession, that when we're talking about these asset management companies, we're not talking about speculators, we're talking about fiduciaries, people who are managing savings assets. And so that level of professionalism just went like this in South Africa, which means you manage risk first and foremost, you don't chase around, you're not a cowboy, you understand what your clients' needs are, and you manage that mandate.
Wasn't it also the insurance companies dominated, you know, in the long distant past, the savings and investment pools, and asset managers came along and sort of specialized in that, whereas it was sort of just a function within the insurance companies, whereas they then started providing a much broader and deeper kind of service.
Well, you know what, the reason why I started where I did is because you actually had two starting points. You had the insurance companies who were managing the savings assets for, you know, insurance products. And then you had the private client, the stockbrokers. And it's the stockbrokers who brought the cowboy element, and the insurance element who brought the very conservative, let's not do anything terribly exciting here. And it's really the melding of those into something fairly responsible, but with a bit more pizzazz than just what was going on in the life companies that really took our industry off.
But there has been a shift towards independent management, and that of course has been a shift away from the dominance of the life companies.
Well, I have to say, there's the first article before, you know, and I want to come back to the intro, I think, Anne, that you had a part to play, because I think it sets out so beautifully what the industry and what the industry has been going through. But Leon Kampfer, who's the CEO for the Association for Savings and Investments in South Africa, writes about the asset management industry. Now, he joined the industry in 1973, and he's been a critical part of this industry right through. And he talks about how the industry started off as life insurers, and how the life insurance model for asset management changed into much more specialized focus, value and growth silos, and specialist managers, and many of the big names are those businesses that started maybe 2 decades ago. And then he speaks about the evolution in 1995 into multi-manager and how that changed the industry again. And he said, quite frankly, well, you know, this is a continuous evolution, and there's going to be a next step for this industry, and at some point that's going to happen. As a matter of fact, just want to quickly show you what some of the returns look like if you look at life companies relative to investment managers of life insurance companies, and then what they call non-traditional managers. And those are managers that are standalone asset managers that literally only try and sell you an investment solution. You can see what the returns look like for non-traditional managers versus life companies, and this is work that was done by Momentum, and it looks at returns specifically from January 2007 to December 2011. And that's a telling chart for me, because you need to create the returns in order to attract the clientele or the investor. But you also need to make sure that you potentially have some really decent shareholders behind you, and that you have somebody with a long-term view as far as the business is concerned.
Well, I think I argue in that opening article that the two ingredients to success are a good shareholder who understands exactly what you're capable of doing and what you're not capable of doing, and a good client who understands exactly the same thing. So I think one of the great travesties of the industry is that when you are owned by an entity like a financial service company that isn't specialist in asset management, your expectations are far exceed what is deliverable. And we've seen a horrible spate of asset management companies, perfectly good, talented people getting shut down or businesses closed or whatever, simply because people don't understand performance.
And you talked about 1998 and the number of asset managers and asset management companies that fell by the wayside during that period, and how many remain standing today. So just to remind us what took place back then.
Well, were you going to show something about that?
Yeah, as a matter of fact, I mean, Anne makes a good point. Have a look quickly at the screen at the moment, and you'll see. You could see what the landscape looked like in 1999. You could see how many managers were more growth focused, or what we call growth at a reasonable price, and how many were value managers. And look what it looks like today. Look how many more managers are value based today. And I mean, within those
and
constraints,
we know why that was. We know why that was, and that's worth an explanation.
Yeah, I mean, I think the market, number one, has changed obviously from being much more momentum focused to being an emerging market that becomes much more value focused. So that means that as an emerging market, we have mean reverting price to earnings ratios, and quite frankly, you need to be a manager that understands valuation in order to make money out of a market such as this. So, the market has changed maybe slightly. Secondly, I think a large portion.
You're much too charitable, Cobie.
And I think maybe the second issue that you need to take into consideration is that a lot of people that were in the industry in 1999 are maybe no longer in the industry. A lot of businesses have either fallen by the wayside, as Anne has quite rightly said, or alternatively, has been bought by other businesses.
Well, basically, you point out the only survivors of that 1998 new managers crash, as it's being called, Allan Gray, Coronation, Foyt, and Prudential. Of course, the ones that didn't have to revamp their philosophy, investment style in order to adapt to the new environment.
Well, let me explain why I put that chart in, because that's why I said you're being much too charitable. Because why did people suddenly say, I'm going to launch a new company and I'm going to be a growth manager? Because they just had 5 fantastic years of delivery in growth small cap investing. So everybody goes out and says, okay, I can do this. I'm going to set up my own boutique. I've just been a star over at XYZ company. I'll go out and make some money on my own. And they set up, and they use exactly the same sort of model that they're used to, and they say that's a success. The problem is by the time they get to the marketplace, that's capped, that's peaked.
Well, it turns to a value cycle.
It turns into the value cycle, and that's why in 1999, the year that you just showed all those growth managers emerging, that was Allan Gray's absolute,
nemesis.
No, it was the year that they went absolutely through the roof. Do you remember?
That was before the tech bubble burst.
98 burst.
Yes.
Small cap growth went down the tubes. Yeah. Allan Gray sitting there in their value shares, and large cap just went right through the roof and went straight on up after that for the next.
What has it been about the Allan Gray model? Of course, founded by CEO Allan Gray, that has been sustainable and gone through such rough times, and of course come out stronger and of course a dominant player in the world today.
Well, I think it goes back to my first point, that the 2 things you need, you need 3 things actually. You need to be in the right place at the right time. And the problem with Allan Gray is that they weren't always in the right place at the right time. So they almost went out of business. That's one of the most important part of their story, that they almost went under. 1992 and then 1998 is the other time period. They lost as much as 50% of their assets. So why didn't they go out of business? Good shareholders, good clients. People that understood. When you see those Allan Gray ads that say long term, I mean, nobody is confused about what they stand for. They don't sit there and say, oh, by the way, last nanosecond, our performance was number 1. They don't even say we rank number 1. They say long term. And I think Allan Gray was actually quite phobic about marketing and quite phobic about the media. In fact, he said if you're a really good fund manager and you're showing a lot of airtime, those 2 don't mix. So.
For you, what stands out as some key developments when it comes to the evolution, and what's taking place right now in South Africa?
I think there are 2 things that we can probably add on from what we've just discussed. The first is that there's been a huge shift away from, let's call it in terms of the money being allocated to specialist kind of managers to balanced kind of strategies, which has focused the industry's attention much more on trying to create more stable returns through time, and this whole shift away from a benchmark to a CPI kind of mandate or target return is one other demographic change.
Does that make sense to you?
Well, it makes sense in the end investor's mind who wants to stay ahead of inflation, right? So they need some kind of CPI plus something. But what is a problem for me in the industry is that a CPI plus X% is not a benchmark, it is a target return. We should never confuse the measuring skill against the CPI plus X target return as something that is necessarily good skill, because there are many portfolios that don't require skill that have also outperformed CPI. So there's been a bit of a disconnect between a target return and a benchmark, which is, I think, going to have to reassert itself at some point. And then the other thing is just that I think the massive shift away from managers who used to own the client's entire portfolio to managing a much smaller portion of their portfolio, and it brings into the whole mix the asset consultant and the multi-manager's role, which should be managing risk at fund level much more tactically or strategically than the actual fund managers can. So fund managers can't actually manage their entire client's risk anymore.
You know how I divide it? That what the consultant is actually doing, and the multi-manager, even if some kinds of multi-manager, is they're managing the liability side. In other words, where the client needs to get to, and what kind of ride they're prepared to take to get there. The asset manager is managing asset side. And so those two, you can't separate them if you're trying to get somewhere.
Where does the multi-manager fit in that?
Well,
in between?
What a multi-manager will do is try to understand where are there some generic pots that we can build that will get to specific targets. So multi-manager was never designed to be a return driver. It was designed to be a very safe road and very highly probable delivery road to a specific destination. And all it does is say, what combination of asset classes and managers do I need to put together to get to that destination with the highest probability of success?
You know, I think the interesting thing here for me is that the debate we're having here today, if we had to take ourselves and we had to kind of put ourselves back in the 1970s and maybe the early 80s, this kind of debate would have never have happened. And I think that the industry has become, firstly, a lot more complex. I think there's obviously factors that influence that from overseas, but it's also legislation and regulation driven. So there's a lot of legislation and regulation today that you just didn't find in the 1970s and the 1980s. So starting an asset management business, making sure that it potentially makes money by actually attracting clients has become a lot more difficult today than what you've potentially seen in the past. And I come back to Anne's earlier point, being at the right place at the right time is just critically important. Now the big issue for the big asset managers is they've got legacy product, which is maybe balanced and conservative and moderate, and those are products that have obviously been run for a very long period of time. Absolute products, which are much more CPI based, and you know, and to manage and to make sure that the governance happens and to make sure that this business runs appropriately and that you get the right skill into these businesses so that asset managers and good investment professionals can drive those returns become really difficult.
Let's start with the issue around starting a new asset management business in South Africa in this environment. How tough is it? I mean, Roland, your evaluation of all the players that exist, specialist boutiques, the Allen Greys, the Old Mutual, how tough is it to find a niche space to operate?
It's very difficult. I think what most people are selling is their track record. In other words, those that can afford to will just keep selling that rather than try and fix something that, you know, if it isn't broken, don't fix it kind of mentality. I think for the new guys entering the industry, it is very difficult. I do think that you have to sell yourselves to the multi-manager now much more than you used to in the past. And what do multi-managers want? Well, they want some kind of consistent process, but they also want to understand right now what kind of building block do they need to fit into the investment process.
Do you know what really breaks my heart, though? What really breaks my heart is that you don't have in South Africa a culture of people that say, you know what, I want to get into investment management because I see an alpha opportunity that nobody's exploiting. They come in and they say, whoa, value worked, I'm going to go in there because that looks like that was a good strategy. And we desperately, I mean, the multi-manager industry, even though they don't understand this maybe, and the clients. We need differentiated managers. We need people that are exploiting other parts of the market that aren't being exploited. And
Where
right
do
now-
you see those?
Well, right
parts?
now that game's going to the smart beta guys, the guys that are saying, well, if all the asset managers are taking 2 steps to the right, we'll go in there and create a passive block that will capitalize on that alpha opportunity. Let's say it's momentum or something like that, that isn't being exploited by the asset managers.
Most fund managers buy cheap shares, right? They tend to have a value bias. So there's other forms of return that you're not getting by having active managers. So and sort of highlighting that.
But you know, they're good houses out there and good asset managers who aren't getting any assets that are doing those kind of strategies. And they're not getting the assets because people don't understand what they're looking at.
Well, I'd probably argue, sorry, Sam, but I'd probably argue if you're a new value manager on the block and you're going to multi-managers and your market is to try and get money from multi-managers, you are probably going to be living off cat food for a very, very long period
Unless
of
you're
time.
BEE.
Well, I mean, it just becomes really, really difficult, you know, for anybody to look at you because you're just not differentiating yourself. It'll be interesting to see what happens, like for instance, in the smart beta space and how people potentially package those and offer it at an attractive price, because it should be offered at an attractive price.
But it's not selling, is it?
No.
It's just not selling. And it's not selling because we have a very entrenched clientele here that has bought into the idea of traditional active management, believes in the dream, doesn't understand what's actually happening in the industry that could be impacting on them as that cycle changes. And it doesn't have to change, it's already changed. I mean, if you look at the active passive issue right now, most fund managers in South Africa massively underperform.
Is this the biggest, is this a threat? I mean, how would you define the passive issue right now, exchange traded products, and what that kind of investment product means for the world of asset management as it stands right now? Roland.
Well, I would use the analogy of, if you remember in the past, you had to get your groceries in different places. So you get your meat from a butcher, your bread from your baker, and you had these specialists. And then the supermarkets came along and opened up on the street corner and said, you know, buy your bulk goods here for less. So buy your milk and your cheese and those kind of things from us. And these kind of businesses had to reinvent themselves to become much more sort of delicatessen kind of shops or specialists in their field, much more so than they were before. And I think we're going to see that in asset management. In other words, the supermarket has arrived, and the supermarket is cheap beta, and that's where people are going to capture the market returns as well as excess returns, because you can have a value index, you can have a growth index, you can have a momentum index. And once that's established, the fund managers will have to sell themselves in a much more specific kind of way. That's how I see it.
But I mean, the guys that are seriously a threat here are obviously the big life companies, the very large asset managers with multiple products and so on. Much more a threat than, say, for instance, a bespoke asset manager with potentially with an offering on the table that they could potentially create a bunch of core values on.